Hello, everyone, and welcome to this week's podcast. Today is May the 5th. Happy Cinco de Mayo, first off. But we are recording this as of around 2 o'clock on May the 5th. We're already seeing some interesting action on this Thursday after really what's been an interesting week overall. We'll look to touch on really what has happened on the index charts as well as within the indicators themselves, and then just briefly touch on really what we heard from the Fed meeting, what our thoughts are there. Really not probably much is going to change from what you've been hearing us talk about in many ways, but doing a recap here of what's happened, especially over this past week, is worth taking a brief on. And then from there, getting an idea of our perspective on other things too is our goal here for today. So first and foremost, we'll start off with just the general look of the market. Obviously today, we see that it has pulled back over 3% as of the time of this recording. On that 20-point per box chart of the S&P 500, we see that it reverses down into O's there and has fallen down to 4140 again after we had gotten up to the point of forming a double top there at 4,300 and didn't quite break it, but had a pretty significant rally after yesterday's Fed meeting. And that was interesting to see the market rally after that, which, again, I think Jamie's got quite a few talking points on that part. But we'll keep diving on into a few other things here as well. As far as the indicators go, we'd seen it as we touched on early in the week and some of the other in our morning videos as well as other areas that we saw the bullish percents move down to prior levels, low levels that we had seen them reach earlier this year. Namely, looking at the bullish percent for the NYSE, we saw it move down to that 38% level. Even looking at the bullish percent for the SPX, it fell down to 36%. But with yesterday's action and yesterday's rally that we saw in the afternoon, we saw a lot of these bullish percents move back into a column of X's. And namely, looking at the bullish percent for the S&P, we saw that reversal occur back into a column of X's at 42% and move up to 44%. From there, we also saw the bullish percent for the NDX as well as the bullish percent for the S&P 400 rally and move back into a column of X's as well. So with yesterday's action, we're seeing a little bit of an increase in upside participation. Obviously, some of that is getting negated with Thursday's action here as we see the market down. But a lot of this is been talked a lot about around the office, Jamie, is just what the response has been to what we've heard coming out of the Fed. So it needless to say, has caused quite a few swings over the past couple of days.
Yeah, to put it mildly, I think that's right, David. I think yesterday we had Chair Powell come out and say that, there was no plan for a 75 basis point hike in the future. That was something that had, kind of gotten a lot of press. Was the Fed going to have to do these kind of jumbo hikes, as it's been termed, to try and combat inflation? Came out and said that they were not actively discussing this. The market took that as a good sign, at least, at that time. And we had, a pretty massive rally in the afternoon yesterday. Now, of course, the market has reversed course and given up all of the gains that we made yesterday. And depending on what you're looking at, I think the Nasdaq 100 has actually moved lower than the low from yesterday. So in some cases, giving back all of that ground plus some. And I think the market not necessarily really buying what the Fed is saying. Fed futures today pricing in an 82% chance, last I looked, of a 75 basis point hike at the next Fed meeting. I think that's pretty interesting, given that's Powell pretty much said yesterday that there were no plans for a 75 basis point hike. So clearly the market has, some different ideas, maybe not thinking that the Fed is going to be able to effectively combat inflation without moving rates up more quickly. Whatever the rationale or the thinking, behind the move, we're seeing the consequences today. You already talked about the BPs, and today we're seeing the NYSE high low it fell to 10 yesterday, and with today, would not be surprised to see it fall into single digits, which is really pretty heavily washed out territory.
Yeah, it is. And I mean, looking at what we saw in the, one of the headlines that caught my attention this morning, obviously, as I'm sure it caught many people's attention, was the Dow being down at one point over 1,000 points. And looking at that, I mean, it's not like we've been immune to days where we've seen 1,000-point moves by any means this year, but the last time we saw 1,000-point, at least from a close to a intraday low, 1,000-point down day, was the end of February. So February 29th, last Friday. So it's not been that long since we've seen it. But I mean, we had a couple days in February, one in January. But generally speaking, when we look back at 2021, when we're looking at those, 1,000-point down in intradays, it was pretty muted for 2021. And we've already had, with including today, 4 days where we've seen the Dow drop 1,000 points, at least in a day. Now, it may not have closed down 1,000 points, but it's at least dropped 1,000 points. And, when you look at that in combination with just the volatile swings we've seen this year, even looking at the down days you've seen a lot of volatility, to say the least, and it's not been without a level of some uncertainty there. Obviously, you have when the conversation around the fact that even when the Fed chairman says we're not going to see a 75 basis point hike, most in the market think it's probably going to happen in some way, shape, or form. But it leaves us in sort of an interesting paradigm, if you will, of trying to fight inflation, but not too much or trying too hard, or at least the Fed's giving us that message. But really seeing a market that when we're getting reactions to that, it just leads to volatility. I mean, it's been the biggest story.
Yeah, and you saw the VIX dropping pretty significantly. On Wednesday, falling from around 29, getting down all the way to 20, 24, 25 at the close. Down 8, 9, 10%. Really potentially indicating that people were taking off some volatility hedges, that maybe there was some calm returning to the market, and all of that has very quickly reversed today. The VIX up over 22% right now, above 31. So, really just across the board, a real reversal of the action that we saw yesterday. Yields had fallen following Powell's comments. That has reversed. The 10-year has moved higher than it was prior to the Fed meeting. So really, there's people talk a lot about the market not always getting it right, and the first reaction not being the right one. And that really seems to be the case here, as the market's mind, or the investors' mind that make up the market movement, really seems to have shifted in the opposite direction just over the last 24 hours.
Well, and I mean, it's not like it's the first shift that we've seen in this year. I mean, we've obviously seen a lot of sector changes. We've seen a lot of even asset class changes. The one piece that's interesting to me, as far as like you mentioning, sort of deciding what the drivers of the market are. Looking over the past week, looking at those DWA groups and sort of the sector performance there. The interesting piece to me is that you see semiconductors, a beaten down sector, is the best performing since last Friday through last night's close, obviously using the benefit of yesterday's rally, but semiconductors is the best performing. Then you have oil and oil services, then building and chemical and electronics. So you've really got this weird, interesting laggard bounce out of some really beaten down areas in terms of electronics, building and semiconductors, but then your leadership is still there as well. So it's interesting to see another piece of cross current almost for this year, and what has been a year that has been full of cross currents for really the lack of a better phrase. So we find ourselves in yet another interesting week, and we will come back again probably next week to report further on what we have seen this upcoming week. As we noted, we've seen some positive action after yesterday. We'll see what today holds in store for us, see if those bullish percents can hang in there, and really if today might just be a one-off reaction and we might get some upside, but we shall see what the next week has in hold for us. But as always, thank you for joining us on the podcast today. We appreciate it. And feel free, if you have any questions, to reach out to the analyst team at 804-320-8511, or you can email the analyst team at dwa@dorseywright.com. So again, thank you for taking your time to listen, and we will see you guys next week.